Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I'm one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. We're messing around with our backgrounds a bit, so if you watch these episodes, feel free to give any advice. Tell us whether you like it or not. If not, that's all right. We got plenty of fun topics to discuss today as well, and it is the heart of earnings season. Most of big tech at this point has reported. We are going to go through sort of the three best and three worst earnings reports that we've seen so far this quarter. Um, so we'll get to those in a bit, but I guess Brett, welcome in.
Yeah, glad to be here, Ryan. My background's in a work in progress mode, I would say. We're getting a little bit better, but I think yours is pretty darn good. So I don't think any improvements needed there. But yeah, new camera working with over here. Hopefully the video quality is better. But I'm sure people don't really care about that. We want to talk. What are we talking about today? Spotify, maybe a little Google, definitely Palantir. I have them in my earnings and potential bubble watch. Well, I know the Palantirians, as they call themselves, won't like that little match group shakeup. PayPal, if I didn't mention them, tons of stuff for the earnings that we like to follow. And if we want to start in, well, you have the advertisement to read, Ryan. But after that, the tariff war, about 20 hours worth.
Yeah,
Let you to buy something, huh?
we should say, I guess, pat on the back to ourselves because we survived Tariff Monday, the treacherous day that was, I think, like a 2-hour long drawdown in the index that has since recovered. I believe, if I'm not mistaken. I don't really keep up with the index that much, but it's amazing how we've gone from being an expert on AI infrastructure. We had Project Stargate, which meant we were going to grow our spending forever. And then we had DeepSeek, which meant that costs were only going to come down. And DeepSeek Monday actually led to a bit of a drawdown. I think it was a 15% or something drop in Nvidia's price. I believe it's recovered since. Anyways, and now we've had Tariff Monday, which I will disclose I bought some of a Mexican company that we have been talking about on this show before. Gave me a little bit of an opportunity to buy on a drop, although that drop has since continued to drop. So I guess I'll have to potentially add more. But with that said, before we get into things, I want to talk about our friends at Public. If you are serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving. So you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured, US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. Paid for by Public Investing. Full disclosures in the podcast description. So, where do we want to begin? Do we want to talk about Tariff Monday?
Sure. Do you have anything on that?
Not
Maybe I can
really.
talk through the summary. There
Yeah,
there was
give
supposed to
a
be.
brief summary of the news that was not, and sort of the implications and why it kind of scared markets.
Well, I will say there is still news, quote unquote, for China, which I think confirms our viewpoint that a lot of these trade war things are going to be targeting towards China, whether the rhetoric is towards other countries or not, because that's the one that is still there. They got rid of that de minimis restriction thing, or they restricted that thing that Shein and Timu used to not pay taxes, I believe. But there was supposed to be 25% tariffs on Canada and Mexico, and now they're paused. Uh, for whatever reason, it seems like it's stuff that they're working through on a political level. But I think from my viewpoint, it's very hard to see why any of these sides would be or at least, well, I'm thinking Mexico and the United States would be incentivized to enact these because it's going to really hurt either of their economies. And I think that's kind of going to lead to the status quo to continue, especially if China is getting taken off the board.
Yeah, I think I saw maybe one too many overreactions to this news, and
Yeah.
I think something that a lot of people maybe overlook is the fact that Trump often comes out with big, bold ideas and statements like this, bit as a negotiating tactic and maybe for some political leverage. So my prediction would be that not a lot changes. There would be, to be clear, there would be some companies affected by this if there were a 25% tariff on all goods coming in through Canada. For example, I own some home builders. We import a lot of lumber from Canada. Potential hike in prices for the lumber would get passed through to consumers and potentially hurt affordability, maybe volumes decline. So there are companies that would be affected. There's other important goods that are imported from Canada, but for the time being, I think it's on delay, and it seems more so than anything else like politically motivated and sort of a tactic for gaining some political leverage and maybe trying to push some of his initiatives by using this, I guess, weapon against some of our allies. So anyway, all that is to say, oftentimes, and this especially if you invest in Mexico or invest in any of the companies in Mexico, and I will say I was interested in buying the Mexican airports that Brett pitched recently, and this gave me an opportunity to do so. With Mexico and the US specifically, you get a lot of headlines that are
Yeah.
just that, headlines, and they drive major sell-offs that are typically unwarranted. More often than not, they result in nothing. So, and you saw it. I mean, we talked about the tariffs, and then a week later, or whatever, a day later, there was a tweet from President Trump that said, "I had a good conversation with the president of Mexico. Things are going great. It's all
It's a
fine."
lot of, yeah, it's a lot of news and stuff like that. I mean, and look, the I still find that the perception among, and it's probably US investors or maybe just ones from other countries as well, the perception of the country is wildly off. If I put something out on Twitter regarding them, there seems to be like half of the people have this idea that the cartels run the country, like it's Al Qaeda. I don't. That's not remotely close to the underlying reality. And then they talk about the ha, ha, there seems to be an idea that it's only basic manufacturing, when in reality it's automotive parts, automotive assembly, medical technology, aerospace parts, and electronics. So a ton of the stuff that the United States just eats up, that the United States consumers just spend a ton of money on. So yeah, I think there's still an opportunity there, and it's really hard to see how over the long term the relationship between the two countries deteriorates versus gets better, just because the incentives are there. Now, can things go wrong? Sure, things could go wrong, but right now, s- despite wild headlines, things seem to be going just as you would expect the incentives to drive them.
Yeah, I mean, there really isn't that much to talk about with the tariffs because China seems to be the only one affected. And Brett and I sort of have a no investments in China policy that we've both adopted. So, yeah, I think it's kind of a nothing burger here.
There was a bunch of people tweeting about value stocks in China. What if I told you there was I had this tweet, this is a tweet that I had, but, what if I told you there was a country with stocks just as cheap as China that has a positive demographic pyramid, which, their population pyramid isn't inverted and has a bunch of old people, it has a bunch of young people, and they don't have the Chinese Communist Party, and they have a relationship with the United States instead of an adversarial like, they're an adversary. That's Mexico, and if you seem to be attracted to China because of the low PE ratios, why not go to Latin America instead, or Japan even though that demographic pyramid's a bit worse, but
It is, yeah. The low PEs have been just the gift that keeps on destroying investors over there for probably the last decade. It has seemed cheap for quite a while with a lot of these businesses, and there are other factors that affect the true value of those businesses. Let's talk about another company that can never go down, apparently. Apple.
yeah.
I'm gonna, you know what? Let's go through some of the numbers, shall we?
Well, yeah, they had earnings, right?
Yes, they
Fine
did.
earnings, slow growth, about the same as usual. They're I think the only Mag 7, well, Tesla too. I guess I don't even include Tesla in the Mag 7 in my mind, but if you go to Meta, Microsoft, Alphabet, and Amazon, Apple is the only one that's not growing double digits, at least on a top line.
Yeah. I'm going to pull up revenue and free cash flow here. So, just for context, and look, I know this story's a little played out, honestly. Like everyone says the same stuff that it's not growing and it trades at a ridiculous multiple, but I'm going to put some actual numbers on it. So, in December of, let's call it 2022, uh, basically revenue has not grown on a trailing 12-month basis for Apple. Revenue has not grown for 2.5 years. It's been relatively flat. You could pick a certain point in time where maybe it's gone up sort of by a little bit. But
Adjust that for inflation too. It's down.
and if you really look at the hardware businesses, at the iPads, the iPhones, the Macs, the wearables, revenue is definitely not growing. Services has been kind of the boost here because they continue to, some people would say, take more value than they deserve from that segment. But also, what I think is important here is that beyond, people have been pointing at, okay, yeah, sure, they're not growing, but they generate tons of cash and it's becoming more profitable. Profits have gone nowhere. Free cash flow since March of 2022 is down 7% on a trailing 12-month basis. Now, they do return a ton of cash to shareholders. In fact, let's see if I can actually pull this chart up for everyone so that I'm not just talking random numbers here and people can actually visualize it. If we look at free cash flow versus, let's go repurchases of common stock and common dividends paid. Okay. So in the last 12 months, they between common stock buybacks and dividends, they have returned basically $120 billion to shareholders, which is a lot of money. And
In the
that's
last
the,
12 months?
yeah.
Yeah.
So 15 million in dividends, 105 million in buybacks. Well, 104. Free cash flow over that time, 98 billion.
Wow.
The
Above free cash
capital
flow.
the capital returns are not sustainable at this rate unless they're able to juice that free cash flow even further. And
And I don't know if you're about to mention this 37 times earnings figure, but the fact that it's trading at 37 times earnings, I think these repurchases are destroying value.
yeah, it just doesn't make sense to me that, so the numbers came out. I looked at them and I thought, wow, relative to expectations, the stock's going to get hammered. The stock did not get hammered. I think it went up 4% the next day. This I think it's just a stock that defies gravity. Honestly, there's so much passive ownership in Apple and so many people that probably blindly own it or might not even know that they own it, that there's just no one selling. And if you have owned it for a long time, which I think most Apple shareholders at this point are not new shareholders, they've probably been around for quite a while. You've got a giant tax bill if you decide to sell. So I don't know what, I honestly don't know how it stays at high 30 times earnings. It is the most expensive big tech company on a forward and trailing earnings basis, unless you include Tesla, whatever. It's more expensive than Nvidia on a forward earnings basis, and it's the slowest growing by a mile. It makes no sense to me.
Yeah, it makes 0 sense.
And
It's
okay, so here's the other thing that I've seen. People say, "Well, this is just part of the cycle. They slow down and then they ramp back up." Do you think there's any possibility that that happens? That this is kind of like I've seen some comparisons where people are like, "Well, it slowed down in 2016 and look how well that turned out." First of all, it also traded at like a single digit earnings multiple, so it reflected it in the valuation. Do you think there's a new cycle coming?
where would that come from?
I don't know.
Vision Pro's a bust. The other wearables aren't big enough. iPad is doing fine. Yeah, it's a good business, but that's small. Is there going to be a doubling of services revenue? I doubt it. And in fact, there's risk that they just put in their annual report that the Google payment may go away because of these lawsuits, although who knows what will happen with that. Is iPhone revenue going to soar? I don't see how. It's almost impossible for them to gain more market share in the United States because, at least among the younger generation, they're dominating with 90% market share. Are people going to upgrade quicker? I don't think so. These AI tools are a total bust. They made a major announcement among some Partiful competitor that they are somehow going to have. And is that going to make people upgrade quicker? No, because at the end of the day, what matters here is the rate of upgrades. And that has been going in the wrong direction for 10 years. And that's fine. That's how things go. You have a quality product, people aren't going to upgrade immediately, but it is a headwind to growth. And looking at Apple, if you've held it for a long time, sure, maybe there's no reason to sell. But Buffett doesn't sell his big winners, his wide mode investments, unless it's staring him in the face.
Yeah,
And
usually ever.
he's telling investors that he is not going to repeat the mistake of Coca-Cola in 1998. I think it was 1998. Whenever Coca-Cola was trading at 50 times earnings, he's saying he's not going to make that mistake because Coca-Cola, I don't know if it's been dead money on a total return basis, but I think it's almost been. Let me look at a chart here. This is excluding dividends. Coca-Cola was trading at $43 a share in 1998. Today it trades at $63 a share. Now there's a lot of dividends in there, but I I could see the same thing happening to Apple. Where is their growth coming from? Where is their innovation?
It's all coming from services, and the innovation there is questionable to say the least. The that that's what just doesn't make sense to me. Like, what honestly, what is going on here? Revenue is going nowhere. Cash flow, profits really pretty much going nowhere. They are getting slightly more profitable mm, if you zoom out far enough, but
Sure, but that's because
it's
of services. Yeah.
yeah. The largest single shareholder is liquidating, and he is not someone that just does that. Like
But
he
what's funny is the stock's not going down.
yeah.
Think about just the gravity defiance here.
Yes, they are returning more cash to shareholders than they can sustainably return on a forward basis.
We have
The
someone here saying Apple Pay, that's a great product. It is irrelevant to a company with a $3.5 trillion market cap.
correct. And the economics really don't accrue to Apple Pay in that transaction for the
It
most
just
part.
gets people to stay with to buy an iPhone.
Yeah,
That's where the
sure.
revenue will show up.
Slap a PayPal onto their valuation. Does it make it that
Yeah.
much better? I don't think so.
2% gain. Yeah, exactly. Let's see. We have some questions here on it. Do you think Warren sold out at the end of this quarter? Ooh, that's a good question. I'm gonna say yes.
I
I'm gonna
would
say
say he
yes.
continued to sell. I would say he has probably been blown away that he's been able to continuously sell at this price since he started selling.
Yeah, true, true. Well, there's just so much liquidity in there. I read an article today that 51% of employees in the United States now have 401ks and or like are offered this sort of product, and it, I'm almost turning into one of those Vanguard truthers where they're just this giant lobbying machine to get people to be forced to do this. There's tax breaks on these 401ks, so the employers feel obligated to do this. They match it, and then guess what? They're all going into these index products. And what makes up 10% of the index fund? Apple. So there's just so much flows coming into this that it's really hard to see unless the fundamentals totally break. Um, I don't know why someone would short Apple, but it feels like in a weird no man's land where why would I buy this, especially over any other Mag 7 company where you have Amazon, Microsoft. I know Microsoft's valuations elevated, but you have Microsoft, Amazon, Alphabet, or Meta with more reasonable valuations than Apple, at least at last I checked, and they have the chance to grow double digit revenue for quite a long time here with much, at least from our view, better innovation. But I don't want to talk all Apple the whole show, Ryan. I
C-
know we had some questions here on
Let's
China with them. People I think are aware of that. Someone asked about Celsius. I did a tweet that said I like Celsius stock here. It keeps falling. Just as a full disclosure, I have not bought yet, but I may buy. I think I might do a comparison to another existing holding. That could be a fun video or segment on the show. I think I might wait for them to report earnings. I don't know. I got a lot of stuff I like in my portfolio right now. But Celsius is on the top of the watch list. People want to talk Google earnings. I don't know if that's on your list, but do we want to roll right into our earnings roundup? Your segment you're calling best and worst earnings reports.
Yeah, we can. Really quick before we do, Hershey is in its biggest drawdown in 15 years. Are you in?
Maybe. What's the multiple?
Honestly, not sure. Let's pull it up. I know
Yeah.
it's down like 40%, but it also traded at kind of an extreme multiple recently, so not sure. Let's go. What multiple do you want? Forward EV to EBIT? How's that?
That's fine. That's fine.
Currently trades at a forward EV to EBIT of 15.6.
Well, not bad. How's their capital returns? I know we looked at them like a year or two ago. If the capital
Um,
returns are consistent, could be worth it. Let's see. Shares outstanding. Eh,
The
falling a
dividend yield's
bit.
currently 3.8%.
Yeah, so mainly dividends. Yeah, this could be a good dividend grower. Could be a good dividend grower for sure. You have that pricing power. Yeah, there's Ozempic risk. I think the Mr. Beast risk is not that didn't materialize, but there could be long-term headwinds from maybe a peak obesity with these weight loss drugs, but perhaps that's priced in right now. I don't know. Seems interesting. What about you? What do you think?
Yeah, I'm pretty interested. The GLP-1 stuff, that is a risk I really haven't looked into enough. Yeah, obviously, if people are less interested in sugar, Hershey's probably going to be one company that's impacted by that. The I don't really buy the Mr. Beast risk. It I, people
Yeah,
love
that one
Hershey
was
products.
yeah.
Reese's is still the number one sold candy every single year. Now let's hit best and worst earnings reports so far this year, or so far this quarter, I should say. You want me to kick things off?
Yeah, yeah. Like you do that. We had someone that on here. Unfortunately, this one kind of uh, this one made me feel some pain because of how the stock chart looks. They ask, "Do you guys ever look at hymns? It is flying at the minute." We looked, and it's on the watch list. Stock's up, I think, 400%. Ryan saw some people that had it be a big winner. It's up 400% in the last year, and we looked at it almost exactly a year ago. I think we should get, and he may or may not be listening to this episode, but we've had him on the show before. Paul Saro was a big win. This has been a big winner for him. Maybe we get him back on and do an update on the company. But
Yeah, that'd be great.
I'm delaying. Let's get into our segment.
I will say, I anecdotal evidence of the week. I went to hims.com for a
Uh-oh.
little
Undisclosed
little
reasons.
personal here, but
Yeah.
just want to preserve my hair for
Okay.
as long as I can. The and I was curious, like what the process was like. It is a slick interface, and it's in my opinion, a heck of a lot better. I think it would be a heck of a lot better to buy a product through that method than traditional routes. It's just simpler.
Yeah. Amazon's also simple too.
Yeah. Can you do that with, like, anything that requires a prescription?
Well, yeah, for the non-prescription stuff, you can't. Yeah, that's true. But they do have Amazon Pharmacy now, so who knows? It's a complicated industry. We probably shouldn't. We probably don't know enough about it. But you know who does know? Paul Serra. We should get him back on the show. But all right, earnings, Ryan. What's your first one? You want to go first here?
Sure. I thought Spotify had an exceptional report, the one that got away, if you will, because this is a stock that I sold at the absolute worst time because I thought the management team and the company was not really focused enough on profitability. I guess shortly after I thought that, they decided that they were. And so far, the results have been absolutely exceptional. This was, I think they hit 671 million monthly active users, which, I mean, they are close to 10% of the global population, I believe, at this point that are now on Spotify. And it also goes to show 671 million monthly active users. I think that's like a triple from 5 years ago. Anyone that thinks music streaming is a commodity, they have put those concerns to rest. They've been raising prices and growing subscribers while doing so. Revenue grew 16%. They had increasing ARPU because the price increases that they've been instituting. Um, this was I might have already said this, but the second highest quarterly subscriptions additions ever. So I think they added 35 million subscribers this quarter. Um, and the operating leverage is really the story here, and I think why people have kind of latched on. Total R&D expenses, so I just threw SG&A and R&D together here, are down roughly 13% from their peak. As a percentage of revenue, it's down much more because revenue has jumped a lot since that time. So they've seen tremendous operating leverage. Free cash flow margin has gone from 0% a year 2 years ago. Now, that was kind of temporarily reduced to 15% over the last 12 months. So they I guess they just chose to get profitable. They
Yeah.
made the choice to, and really the efficiencies have come through the expense discipline on the income statement. So
Well, gross margins are improving at a pretty good pace.
yeah, I wouldn't say anything structurally changed with the business in terms of how they, like, unless I'm wrong, I don't think they renegotiated some insane contract with the labels where now they have all this operating leverage. It's mostly come
Well,
from headcount reduction.
trailing, no. Forward, potentially. They just signed a new deal with Universal. So we'll see how that shakes out. But they're always very mysterious about it. So we'll see.
So I guess my question to you, the stock's up a lot. Since it bottomed, I think it's up sixfold, maybe more.
Seven. It was at $75 once. So it's gonna be 10 bagger shortly.
Well, would you get back into Spotify? And I guess what lessons did you take away from your investment experience with Spotify?
Well, the lessons are it's okay if something runs if you didn't think it was attractive when you bought it, but then keeps getting more overvalued. I like the business here. I would get back in at the right price, but today it has officially entered the never sell zone. Maybe we can call it that. This is not a good buy right here. Okay. What's their market cap? Let's pull them up quick. This is a great company. Market cap's 125 billion. It's possible they do $10 billion in annual earnings in 5 years. Possible. If that happens, the stock probably barely budges. This is a wildly expensive stock. It's a great business, but I would be very hesitant to buy here, and I probably wouldn't. Here's the thing with something like with a company like this. If I had still held onto the shares, and this is kind of the lesson I think we should take away from it, I still think I would be holding my shares, or that's kind of the mindset I would hope I would have because it has such a long runway to grow. But I'm not buying this thing unless it goes down a lot, 50% maybe. Which is weird. People might say, well, if you would hold it, when you buy it? And I don't think so because there's taxes and you have to look at that, David. This is the one lesson from David Gardner everyone should take away from. When you have a winner, you should be very hesitant to sell it unless it becomes extremely overvalued. Which, speaking of which, we might have one of those to talk about later today.
Yeah. It's it's a long ways away from where I would want to get back into it. The one takeaway that I have here, and I think I've talked about this on the show a number of times, and this is probably, and maybe it's the bubble or the bull market talking, or maybe it's like a valuable revelation that I've had in my investment career. But if you have a business or a product that's really idiosyncratic, it's unique, it's something that's really difficult to replicate. And I think Spotify is one of those. I mean, it truly is a best in class product and it's going to scale. They're they can get profitable if they need to, is kind of the lesson I've taken away. And usually it comes from investor pressure, is kind of the experience that I've seen. In this case, investors were putting a lot of pressure on Spotify. And if you're an owner, operator, you're a CEO, founder like Daniel Ek, I know I'm going long here, so we'll go quicker through the other ones. If your stock's down 50, 60, in their case, I think it was like 70 or 80%, and internally, everyone at your organization is being affected by this because they've, whatever, their options have vested, all this stuff. You find ways to make the stock go up. And in this case, it was to get more profitable and not really empire build. Like I really think when they first went public, Eck was kind of in the empire building stage.
Yeah,
That's changed.
perhaps. Yeah. Yeah, and maybe he didn't care. He was pretty young. I think he's only about 40, in his 40s now. So when they first went public, he was in his 30s. I think maybe he was brought up in the grow revenue and users at all costs, and it doesn't really matter. We'll figure it out later. Well, no, they did figure it out later. And it shouldn't be shocking that when your earnings explode higher, go up by like 500%, the stock's going to start moving because, yeah, it, I think that's the story here. They said they could get 10% gap operating margins. No one believed them. They did it way quicker than I would have even thought they could do. It's there. We have a comment here that said the problem was that Eck told investors every year for a decade that they would be profitable. So the final time he did it, no one believed him. It was kind of a boy who cried wolf situation. And that's true. And I think that's why the stock was trading at such a discount.
Okay. What company had a good report for you?
Well, I'm going to combine this into my bubble watch. And I know it's an interesting company. It's an interesting way to say like they had such a good earnings report, but perhaps this is a bubble company. And it's going to be Palantir. I thought this was one of the most impressive earnings reports I've seen so far this year. 36% year over year revenue growth. That was an acceleration. US commercial revenue, 64% year over year growth. Really, really phenomenal stuff. Ryan's pulling up the chart here. What do you got, Ryan? US commercial revenue. Yeah, I mean, just look at that. It's just, there's almost a step change in growth. And all the stuff they talked about with AI deployment has seemed to work out here. And what do we got? If we combine those, yeah, look at US commercial revenue, 50% growth in September 2021. US government revenue continues to grow. There is a ton of opportunity for this company. The stock now, I think it jumped 25% after earnings. It's up 500% in the past 12 months. Trailing 12-month price to sales ratio, Ryan, 86. We're in snowflake land. Snowflake, not metaphor or like the name calling, but the company that traded at 100 times sales. The market cap here, $230 billion without factoring in any shareholder dilution. I put in a sarcastic comment, "Are you in at these prices?" I mean, no. Ryan's obviously not. But this is, I think, without a doubt, in the Shopify 2021, Snowflake 2021, maybe it was Shopify 2020. It's in that realm now where we have a huge market cap combined with a price to sales ratio that is not going to make sense no matter what happens. No matter what happens, because I this company is extremely popular, so I write about them on the Motley Fool quite a bit. And when I do the math for the articles, I've been doing, say, a while ago, probably, 150 to 100% lower. And I would say, well, they probably need like 30% revenue growth for 10 straight years, and then operating margins needs to just absolutely soar. And maybe that's happening. But now I think we probably need 50% revenue growth for 10 straight years, and the expectations are just getting out of control. So what are your thoughts here?
Yeah, no doubt. This was a really, really good quarter. They are showing good signs of profitability as well. So it's not like sometimes you see companies that are almost powered by like a high stock price that can like really elevate the performance at the actual business level because you can kind of pay for growth. You can really focus on revenue growth because that's what shareholders care about, whatever, and not really just kind of neglect profitability. That's not the case with Palantir. Now, you mentioned the Shopify uh, analogy here. Shopify traded in late 2021. They traded at a market cap of just under, no, they hit $200 billion in market cap. So actually got
Pretty
fairly
close.
comparable to Palantir.
Cheaper though, only 55 times sales.
Yeah, they hit 55 times sales. And if you're thinking, well, Shopify's actually done okay.
No. Mm-mm.
Relative to that high, they are down still 30%. So over the following 3.5 years, it's been a negative 30% returns. And I think revenue has doubled since that time. So there comes a point when a valuation can just simply get too extreme. I think Palantir has hit that. The performance has been really, really good. This was the KPI that stood out to me, and we should plug FinChat here. If you go to FinChat, you can see that their commercial customers, they added more commercial customers than they ever have in a single quarter, and it I guess the runway for commercial revenue, I would think, is higher without knowing the
Sure,
business
it's
super
high.
well.
Yeah, so what? What are they gonna do? $10 billion in revenue? Great. The stock's still overvalued.
Yeah, yeah, it is. I mean, I'm
Are they
certainly
gonna
not
do
making a
$20
case
billion?
for it.
Are they gonna do $20 billion in revenue? It's still overvalued.
Yeah, yeah, it is. Let's okay, good report, but yeah,
Well,
also on
you
the
wanted
bubble watch.
within the bubble watch, you had this note about the Enron egg. This was old news, Ryan. You always give me stuff that's about 3 weeks old.
This was
Well,
I didn't realize this was so old.
yeah. I mean,
The
it's a scam. It's not real.
at home nuclear? You buying?
No, I blocked all these people on Twitter. I don't want them. No Twitter promotional, whatever those things, the money you can make from views. I don't want any of that going to this Enron scammer.
If you're
It's
gonna
one
be
of it's this the curly haircut guys are just trying to be funny, and it's just like YouTube people, you know? It's like
I
YouTube,
w
not scammers, but pranksters that are doing this. It's great, but I don't want anything to do with it. It is a
yeah.
sign of a bubble, though.
Yeah, I do not wanna give a whole lot of attention to it, but I will say, if you're interested in becoming a fraudster and, like, trying to, I guess, like what's your reputation worth, and you're willing to sell it. The This is the blueprint for it. Like, you do a catchy name, some product that is kind of outlandish, marketing is just, like, all gimmicks, and you can attract the wrong type of attention, but it is attention. So I will say
Pay
that
famous people
yeah.
that just want money to somehow hype your product in kind of a really fake way. What's weird though, we have a comment in the chat here that said, "I had family members who fell for the Enron news." Yeah, I guess we're in the mix of the FinTwit stuff. We're maybe skeptical. We're looking at this stuff all the time. We know that there's just these pranksters, jokesters, scammers that are constantly out there. But for people that aren't in the industry, it can be kind of hard to tell. And I feel bad because there is just a tidal wave of scammers out there now, isn't there? It's terrible. And think if you have someone that's 80 years old, oh man, don't even let them have a phone anymore.
Yeah,
No,
seriously.
can't go online.
Okay. Last great report that I saw for this week. There were some other ones, but and I thought Google had a pretty solid report, but I don't know if there's a
Stocks.
whole lot to touch on there, to be honest.
Mr.
It
Market
is,
disagrees with you, Ryan.
yeah. Well, the the market changes its mind on Google every quarter, and it makes no sense. But I want to talk about Meta. I know this is a little boring because everyone knows Meta, and there's nothing like no crazy insights here. But the family of apps business hit 60% operating margins this quarter. That's its highest figure ever. And well, the one thing that always just blows my mind is the fact that they still have user growth. It's somehow they continue to grow users at like mid-single digit percentage despite touching half the earth.
Well,
Um,
the emerging markets, that population is growing. Africa and Asia.
yeah, I mean,
A lot of
basically, I
people live
assume
there.
they'll just grow with internet penetration in emerging markets.
And those population pyramids,
Yeah,
I love talking population pyramids. They're a little more attractive. There's gonna be a lot more people in the 10, 20s, and 30s in those areas.
yeah. Anyway, the thing I actually like potentially about Meta here is yeah, and we just got a comment on it. There's been some kind of leaks and commentary from people in the company, and I think someone basically said at Reality Labs, if we don't get something into the mainstream this year, they're probably going to pull the plug. So I guess that was. I I know they should do that. Like if they're hemorrhaging $15 billion a year on this and nothing's coming of it, then yeah, they should. But it is nice to know that Zuckerberg does not just purely see this as a forever cash incinerator where they just kind of are going to lump money into it. Now, we still got to wait and actually see. It's one thing to just say it, but we want to see the actual proof of it. Would you have any interest in Meta here?
No, I think stock is premium valuation is what I'm trying to spit out here. And yes, it's a good business. Yes, they seem to be investing in all the right areas, but not for me at this price. Would I be holding it if I bought at the lows in 2022 and celebrating these gains like I know a lot of people did out there? Sure, yeah. Like there's no reason to sell here, but there's also no reason to buy. I think it's another one similar to Spotify that is getting into no man's land, although not as an egregious of a premium valuation here. I like the Reality Labs thing. What I find interesting about those things, though, is that you have all of these super smart tech executives, founders, you have all of the venture capitalists, Mark Andreessen, blah, 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 blah. They're talking constantly. And they say, well, AR is definitely the future. Virtual reality goggles are definitely the future, but it never is.
Yeah, I could. Well,
Oh, you could
yeah.
see it? Yeah, I could see it. This is the same thing I've been hearing since 2005.
No, I'd say wait and see. Yeah, okay,
Oh, yeah,
wait
just
and
wait
see
and
with
see.
the
Mhm.
glasses.
Okay.
The
This is the
goggles make
year.
no sense, of course, but having
Well,
something that's
Vision
like
Pro, I mean, yeah, that look
yes,
like a bug. Remember those videos they pay people to walk across the street? That was a health hazard. These people are gonna get blown up by a bus.
Yeah, it is. Yes. I think that goggles are incredibly misplaced in terms of product market fit. And I think that was probably one where Silicon Valley was kind of in its own bubble and thought that like people would be interacting with this. Remember when every company had to come up with their metaverse plan? Uh,
Yeah, or their voice assistant plan.
yeah.
Yeah, they go through these waves. But who knows? Maybe this will help their profitability if they cut down on some of this, invest in AI instead.
Yeah.
Um,
Let's talk about one of our friends, Blue Chippers. Blue Chippers Club was recently started by two friends of ours with the goal of building a tight knit community of stock focused investors. I've seen a number of listeners from the show already join. So thank you if you've done that. If you haven't, it is a community where everyone can share and break down their portfolio, pitch stocks, receive feedback, and participate in weekly calls. I actually love this idea. It's why we're promoting it here on the show. And if you are interested, it is totally free to join. So head on over to bluechippersclub.com and hit apply. The link will be in the description. And then one more time, I want to shout out Public. If you are serious about investing, you need to know about public.com. That is where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered, SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks. This is paid for by Public Investing. Full disclosures are in the podcast description. Let's talk worst reports. Can I
match
start?
group, match group. Well, I
Yeah.
think we both chose them.
Yeah.
Who went last?
Or
Did
not
you
to.
just do Meta?
Yeah. You go for it.
Okay. Well, nothing surprising here. They had almost the same thing as the last 3 years. Well, total revenue was pretty stagnant, 3% growth year over year, 6% on a foreign exchange basis. That's for the full year. If we go Q4, actually declined 1%, was up 1% on a foreign exchange neutral basis. Operating margin is coming in. Tinder revenue is not doing great. In Q4, it declined 3% year over year. Pairs are moving in the wrong direction. Hinge is the only one growing. Emerging and Evergreen are pretty stagnant. Asia not doing that great. If we go, there's so many numbers with this company, but if we look at their outlook, let's go full year 2025. They're expecting revenue to fall 3% to being up 1%. Foreign exchange can really throw a wrench into the mix. They're expecting free cash flow of about a billion, depending on, again, the foreign exchange rates. I guess the turnaround didn't happen. And you know what they did, Ryan? Is they fired the CEO, which seemed likely given the activist investor coming in. And they brought in Spencer Raskoff, who was just put on the board, I think in late 2024. So maybe the writing was on the wall there. He is one of the, I think, founders. Yeah, co-founder and was a CEO of Zillow Group. And I gotta say, this is perhaps my least favorite pick they can make. I don't know anything about this Raskoff guy, but I do know one thing about Zillow, and they are not a culture of optimizing for shareholders. They have one of the
Absolutely
best
not.
businesses in the entire world, and they just wasted it for many, many years.
This is their fourth CEO in 5 years. Now, when people say that executive turnover is a red flag, this is like example A of executive turnover. Literally, the CEO departing. I think Gary Swidler left too, didn't he? CFO.
He probably got fired. He was the one that had been there for a while. Honestly, if it's probably good to get, even if he did a good or bad job, it's probably good to get a fresh faces in there.
But yeah, every step of the way we've said, "Oh, I didn't realize how mismanaged it was." Good thing we got a new CEO. Oh, good. Oh, good thing we got a new CEO. It doesn't. It, here's the thing. I think this company, it was pieced together by IAC.
True.
It's a company that did not, I don't think, really needed to be together or wanted to be together. There are, we talked about this recently, but if you are, it feels like all the reporting is segmented in a way it feels like they've pieced together the business in a way to delight shareholders that has no benefits internally. If you work at Hinge, or how about okay, so Evergreen and Emerging, right? You've got Match.com and Chispa in the same group, same organization. Those I assume those 2 businesses were built on completely different tech stacks. What benefits are they gaining there? Like,
I don't know. They're also probably irrelevant to the entire thing. It's, you know,
my whole point is, like, I don't think there's all these synergies that people want out of a serial acquirer.
perhaps, yeah. Yeah.
You've got no like, I assume if you're a great developer, this isn't a place you're super eager to work. The it there's been so little development, and the development that has gone on is completely useless, to be just totally candid. Tinder, the AI initiatives are beyond dumb. And I know I'm kind of on my soapbox here, but it's just so like, what are we spending money on? Match.com should just be run for cash. There should be like 5 developers, and that's it.
Yeah.
And Tinder, sorry, if you're not able to reinvent it, maybe you do the same thing or plow all your investment into Hinge. I don't know, but it's not like there has been very little true improvement in the experience at Tinder.
Yeah. I'll still argue though that these are good businesses at the end of the day. Like not the specific cases, they might be poorly run, but the idea of these businesses, the business models are good.
Yeah.
But you can run someone said once, I don't know if it was in one of our chats or maybe it was on Twitter or some comment somewhere. They said that maybe dating app companies don't really lead to management teams that care about shareholders because it seems like both Bumble and Match Group have had executive teams that are not necessarily out there to I don't know. They like good press releases and pretty corporate offices, but shareholders maybe not so much.
Hey, they make a pretty slide deck though.
Yeah, and they got a lot of segment stuff. It's great. Really
Would you
confusing.
okay, is Match Group unownable?
I if they sorry, I was trying to get my words out. If they had a different CEO come in, I would be happy. If they had the CEO with the right pedigree, maybe, but this was brought me further away.
Yeah,
Zillow is not the culture I want.
no, I agree. All right, speaking of other bad reports, you wanna talk about Disney? And let me just preface Disney's report with this stat, because this angers me to no end since I work at FinChat, and
Since you like having segment data for the company you work for? Yeah.
I love consistent KPIs because it makes it very easy to monitor the progress of the business. Disney, over the last 5 years, has either redefined or stopped reporting 16 different segments and KPIs, segment and KPI metrics. That's in 5 years. They are probably they're the worst at this, actually, in terms of reporting and changing their reporting.
Yeah. And
I don't know if I've seen someone worse.
they changed something again this quarter. I didn't honestly, I don't care.
Now they
It was
don't
something
show
about
global
India.
paid subs.
Yeah, Star India, something like that. I'm not exactly sure. Yeah, but if you want those segments, the hard workers at FinChat are helping you. Disney's probably the most hated company at FinChat, but they work hard to get those segments, whatever you want, to get lined up and easily chartable. And you can use our link finchat.io/chitchat and get a 15% discount on any paid plan. Did you see, Ryan, the stat I had about Nintendo versus Disney and the total return?
Yes,
What'd you
I
think?
did.
Were you surprised or no?
I was a little surprised. Although Disney has been so bad for a decade, that one didn't surprise me. The 30-year did surprise me.
That 30-year. Nintendo's still positive versus them, but yeah, obviously not as bad. Let me try to find it. Let's see. I want to get the number correct. Maybe it was
Look,
too old. Oh yeah, here it
I
is.
will say, Brett, being better than Disney is not over the last 10 years is
Well,
not
it's still it's
not
better
a
than the
high bar.
S&P. It's better than the S&P too. Here's the stat, and I was surprised too as someone who's a Nintendo fan. Nintendo 773% cumulative total return. It's actually much higher today after this. The stock has still continued to run. Disney in the last 10 years, a cumulative total return of 35%. Nintendo is still up, I think, over the last 30 years, give or take. Sometimes when you go farther back, I didn't put it on a precise date, but
Well,
Disney's much closer to those returns.
they just need to reclassify the reporting segments and they'll figure it out.
Yeah, exactly. All right, here's where the Disney numbers though. Entertainment revenue up 9%, sports revenue flat, experiences revenue, which is parks and cruises and other things like that in the real world, up 3%. I don't know what people were expecting, but maybe that experiences one was a bit lower because that's been such a good business for them. Today, Ryan, the market cap is $20 billion. I know they have some debt on there, but it's not as bad as it used to be, and they can probably get. They're profitable now. They'll be able to deal with it. My question is, what is the thesis here? Because is there a path? And I think given the $200 billion market cap, is there a path to $20 billion in earnings? I think maybe, but it's hard. It's going to be hard. Netflix, Amazon. Why am I forgetting the other ones? YouTube. Don't forget on the not like the sports rights stuff, but on the talk shows. Spotify is also in there as well. I think the time spent on Disney platforms outside of the young kids watching Disney movies is in such a hard spot right now.
Yeah, it's really hard to answer because Disney's such a big business. It's been so messy that it's hard to really know exactly what's going wrong. But I think it's simple enough to just say the way we consume content is changing and Disney's not as relevant in the modern consumption methods as they were 15, 10 years ago.
Yeah.
And if that's like if theaters aren't the main mode of getting the newest movie, it affects Disney throughout the rest of its business too. Parks become not quite as appealing as maybe they were 10 years ago because people like the IP, but they don't it's not completely irreplaceable. People also like other IP. There's tons of kids content on YouTube for anyone that doesn't know. If you don't have kids, go to Netflix, go to YouTube, look up there's like tons of kids shows that are quite popular. It's just a more competitive world. I don't think there's a clear thesis over the next 10 years that I would ever really entertain.
Yeah, if it works, okay, maybe it's a double. All right, fine.
Yeah. It's just a mess. Honestly, it's a mess. And the KPIs are exemplary of it.
You know what's a name we haven't mentioned in a long time? Roblox. That's out there too. Although I guess they had some
How are
huge
they doing?
concerns with like pedophiles or something like that. I don't know. Don't want to say they actually have that problem, but there was a lot of reporting on that, so that could be a concern. But time spent on Roblox quite high.
Yeah. I mean, it's just there's competition everywhere for time spent. I don't love when people just say like, "Oh, the competition for time spent, no business is going to survive." Like, I don't like that. But when Disney was in like the pole position in a linear TV world, you're potentially going to lose some eyeballs.
I think there's three horsemen: Netflix, YouTube, Spotify. There could be a fourth, but those are the three I've confirmed about a lot of time spent. That's
Yeah.
for so excluding social media. Obviously, Meta's there on a different stance.
Speaking of companies that are like major losers from the competition for time spent, Electronic Arts. This is another really bad report. They've gone nowhere. But billings have gone nowhere for that business for
4 or
4
5
years.
years, right?
Yeah.
Yeah, it's a tough one. You wanna talk about them for the last we can talk one more earnings report.
There's not much there. I mean, it's just they for one,
Stagnant, right?
it's very stagnant. They pretty much have just leaned on FIFA or FC now. And after lapping 2 great years, it's starting to slow down. I think people people used to make the case that video games are just ultra competitive and EA is gonna get left by the wayside. And I thought they were all wrong, but I think they ended up being right because
Well, I don't know if that was the why. I think it's just the publishers it's just not there's not as much money spent on these things.
you think there's less money spent on console gaming today than there was 4 or 5 years ago?
Probably. I mean, that's the heart of the pandemic, Ryan.
I guess, but I mean, they haven't grown since pre-pandemic, really.
I don't have the numbers in front of me. I
Let's pull them up.
think they're up from before the pandemic.
I mean, yeah, maybe the pandemic has just left such a bad comp for everyone, but I just I just don't love this business at all. Okay.
No, it's not a high growth business.
Yeah, it's up like 10% since pre-pandemic net bookings.
Yeah, still not great. And maybe this is something that maybe we got blinded at during the pandemic. I just don't know if video games are a high growth market.
I agree.
How
Somewhat
much money is going to get
saturated.
spent? Yeah.
And yeah, maybe mobile helps like the total gross bookings overall grow just as more smartphones end up in more people's hands, but console gaming, PC gaming, I would bet those are pretty close to saturation.
Maybe. Yeah. We'll see what happens with two big things will be the Switch 2 and Grand Theft Auto 6. We'll see what happens with them. Those will be some big data points. Did you want to talk PayPal?
I don't
Or are
know
we
if
not have
there's
time?
I don't really have any great takes. It seems to be kind of in no man's land, so
It's
maybe I can
fighting an
form some
uphill
better
battle.
takes. Talk about them next week.
Yeah. 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 The one thing I will say about them before we get out of here is why are you investing in a stock that has to fight such an uphill battle?
I had someone recently, anecdotal evidence, and everyone should definitely invest based on this tiny little
the
piece of
one the
evidence.
one data point? Yeah.
I was buying a lawnmower from someone that's just like a local. It's basically, I was assuming it was going to be cash only. And he said, I can do cash or PayPal. And I haven't heard that in so long. And I just thought, like, I, why would I do that? Like, if
Yeah,
you don't have,
Venmo's free.
yeah, well,
They always
I
talk
guess that benefits them too. But like, if you don't
well,
have,
meh.
yeah, true. It's the branded checkout's the way, the real cash generator. But it's, I just, yeah, they are fighting so much competition and they're just like clinging on to their network. I just don't see how that ends up really looking really good in like 5 to 10 years.
Yeah, they're a treadmill business. They're running really hard to stay in place, and it's always my favorite. It's that Star Wars meme when they're like Venmo volumes keep growing, and you're monetizing that, right? You know, like there's
Yeah.
I don't think I've ever given Venmo a cent of money. Just have the delayed transfer. I'm sure I'm a huge loss leader for them.
You have to believe, I think if you own PayPal, you have to believe that over time, branded checkout will be replaced in the aggregate by all their other businesses in terms of gross profits.
And that's not the bet. And you want to compete against Adyen? Good luck with that. Good luck with that. They're losing.
Yeah.
All right, we're going long. Anything else, Ryan, before we get out of here?
I think that's about it. Missed our small cap of the week, but it's not. It was Peloton, and people can
Oh.
guess my conclusions on that one.
We had one that we've had quite a few recommendations from people. Frankfurt Airport. There's too many to do every week. Some of them might turn into research reports. There's one that's like a small grocery store operator, kind of a convenience store operator in Mexico. That could be one that could be for a full research report. People really seem to like that one. We had a question here about Trump's tariffs on China and the TikTok ban and any retaliation there. Honestly, no one knows because it seems like the administration changes their mind every day. So just invest in stuff that's not going to get affected by it. Easier said than done. Yeah, Peloton small cap of the week. That would have been some nice memories. That's another pandemic winner. But all right, let's get out of here. As a reminder, we're not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in. We do these live every Wednesday, 1:30 p.m. Eastern Time on the Chit Chat Stocks podcast YouTube channel. You can watch or listen to the replays on YouTube, or you can watch or listen to the replays on Spotify, Apple Podcast, wherever you get your podcast. We don't care. Listen or watch wherever you want. Thank you, everyone, for tuning in once again, and we'll see you next week. Okay. Oh, I sneeze.